Welcome to forexfilms. It is Tuesday, May the 3rd, 2011, and today we're talking about the death of the US dollar. This is a daily chart for the past 10 years, and you may be surprised that during this time frame in the past couple years, people have really started talking about the dollar being devalued, even though it was lower back in 2007, 2008. It's become a mainstream media talking point, even though no real reputable media outlets were putting that out during this huge downward period where the dollar lost something like 42 to 43% of its value. So, why are we always talking about the death of the dollar and how we're going to have rampant hyperinflation and commodity prices are going to go through the roof? Gold is going to go through the roof. Well, it's partially because of the national debt increasing and the Federal Reserve quantitative easing program. Normally, central banks control inflation and money supply by adjusting interest rates or buying short-term bonds. Well, we started a program called quantitative easing because interest rates have been lowered practically to zero, and it did not bring our economy back. And quantitative easing is really something that started with Japan. Japan has been fighting deflation for a very long time now, and quantitative easing did not happen in Zimbabwe, where they had the hyperinflation, or in Germany, where they had the massive hyperinflation. So, really, the examples that we've had of hyperinflation have not been involved in this process. But other examples of quantitative easing: Japan's still around, their currency won't stop going up. And in the UK, they had a quantitative easing program. They are having higher inflation, but we're talking 4%, and they're still not worried about their inflation. And their currency, by the way, is still gaining value. Also, in the Eurozone, they used quantitative easing, though not as much. So, we're actually in QE2 right now, quantitative easing 2, and there has been some discussion about QE3, but now they're saying that's not going to happen, and in June there will be no more quantitative easing in the US. So, quantitative easing is basically where the central bank buys government bonds and other financial instruments in order to drive up prices and lower yields. Basically, it's just increasing the money supply because they buy those assets by creating money out of thin air. Now, the Federal Reserve, before the recession, had about $800 billion of treasury notes on its balance sheet. And in November of 2008, the Fed started buying mortgage-backed securities, which are one of the main things blamed for the recession. $600 billion worth. And by March of 2009, had about $1.75 trillion of bank debt, mortgage-backed securities, and treasury notes reached a peak of $2.1 trillion in June of 2010. And that was halted until QE2, when the government decided to put $600 billion more down, and that will be ending in June next month. So that's probably already priced in. Now, other things to think of. Debt to GDP ratio. We're almost at 100% right now. But, okay, I've actually got some charts I want to bring up here. Here, from the Federal Reserve's website, is a chart of their assets. Look here to like September of 2008. Massive purchase program. Came down a little bit, like I was saying, and then we've got in here we've got QE2. And this has been very similar to the increase in S&P 500 stock prices. So there's probably a connection there. Now, debt as a percent of GDP. Got this nice chart from zfax.com. Look, 120% of GDP after World War II, and we paid it off until the Reagan years started, when we started massive military buildup. And now, this chart, 93%, we're actually a lot closer to 100% right now. And it just goes to show that even at 120%, we were still doing alright as a country, even though we've got a lot of scare tactics going on in the media and in politics right now. Japan is over 200%. We're talking like 225, maybe 230%. Their printing presses aren't stopping at all since that earthquake they had. Greece, Italy, Ireland, Portugal are all over us in debt to GDP ratios. So it's really kind of silly to concentrate so much on that as our reason for US dollar immediate skyrocket downward. So let's take a look back at our dollar chart now. Remember, this is slightly over 50% euro based. So if you flip this upside down, you'll have a chart close to the euro. Difference is this spike is actually lower in the euro, and the euro has not surpassed this high, and it may not before a turnaround. This, in Elliott wave analysis, looks very much like wave 1, wave 2, to be followed by wave 3, 4, and 5, much higher. We'll come down time period. We've, since 2008, have been sitting close to the same level. We've been in a congestion period on a long-term scale. So, what's everyone so worried about? It actually looks like we're doing fairly well right now. Gonna take it back out and then zoom in. So let's see. Previously I was looking for a rebound in the high 72s, low 73s, and right now we're rebounding off of that, but I don't think that's going to be the end. I think 72.4 is looking good right now. So we're headed to at least 100 on the dollar index. That's actually a lot lower than my target, but we'll talk about that in coming months, years. Here we have a 1 hour chart. This is where our analysis really starts getting heavy. This is really what I put up on my chart of the euro. I believe I put a video out with this on it yesterday. In the euro, it looked like we had a clean cut A, B, C, D, E pattern unfolding at the time, really. And I expected us to drop down to this point and then shoot higher, which happened exactly how I expected it. But now I'm beginning to sense we may get more bullishness out of the dollar before we resume our bearish dollar trend. And the likely spot here is 73.5. If we put in a moving average here, 13 period is what I like on the daily. That would also be where that would be at, and I think if we hit that, we could have one more final bull movement and then have our final base and finally start moving higher in the dollar again, which isn't good for our overall economy, but if it happens, it happens. This could be a 5-wave movement, but it doesn't. This whole pattern right here doesn't look convincing to me as a long-term base. So, one more low, that's what I'm shooting for. If it looks any different coming up, I'll let you know. And please give me comments, questions, like this video, and visit my website, forexfilms.com. Thanks for watching.